Good morning everyone and welcome back to Morning Markets here at True Potential. Monday the 18th of March, so it's a chance for us to look to the week ahead. And there are two events which we believe will dominate the news flow this week, both occurring on Wednesday. They are the UK CPI print first thing in the morning, and then later in the evening it's the update from the US Federal Reserve. And let's talk about this through the rest of the show. So last week was a story about two particular parts of the global economy. We had the US CPI print indicating that it's going to be difficult for inflation there to fall much further below 3%. 3 to 4% inflation in the US for CPI is likely the norm for the next several months. Elsewhere, there's an eye on Japan and the Bank of Japan. The Bank of Japan meet tonight, and it's possible that for the first time in over 8 years, the Bank of Japan may exit negative interest rate policy. And also Japan has had interest rates near zero for over 25 years. Why could there be a change? Well, there are indications of broadening wage-based inflation there in Japan. Nationwide negotiated wages are close to 5%, and this is following around about 25 years of protracted deflation. So it's encouraging that the Bank of Japan may soon be able to exit negative interest rate policy. And this feeds into two outcomes for this week. The UK CPI print on Wednesday will indicate whether we're continuing to see a cooling in inflation pressures, and in fact markets expect us to see the first inflation print beginning with a 3 since September 2021. It's likely inflation will fall from above 4% towards 3.5% as things like food prices continue to cool. But the main focus will be on the US and the quarterly meeting from the Federal Reserve where they update their forecasts. Now markets have moved considerably since the Federal Reserve last met at the end of January. Back then, markets were expecting almost 6 interest rate cuts this year, which would take interest rates close to 3.75% from 5.25% currently. Markets have reduced 50% of their expectations, such that they only expect 3 interest rate cuts now. So there appears little for the Federal Reserve to push against should they wish to update their messaging. But why have markets moved the way they have? Well, it's all to do with growth, and this is feeding into firmer inflation. So we are seeing high employment levels globally, and this is allowing consumer balance sheets to heal and perhaps for some consumers to start to dip into their savings. And this allows them to continue their spending levels despite high interest rates. So central banks are likely to be loath to cut interest rates too quick, and in fact this is what markets have already priced. There is no major central bank is expected to move to cut interest rates before late spring, and even then that is the ECB in Europe. There is no movement in interest rates expected from the Federal Reserve in the US until July, and similar from the Bank of England. And that's really because whilst it might not be coming through in the GDP numbers here in the UK in particular, there is still adequate demand for services in particular, and this continues to keep employment robust. So it's a good story, and that's being reflected in the market moves in equity prices that we've seen this year. Corporates are profitable, the outlook is healthy, and we're even seeing earnings revisions turn positive. So it's a good story to start the week, and we'll update you on Wednesday with, first of all, the UK CPI print. Thank you.